And now for news across the local market, I was joined by Martin Lakos from Macquarie Private Wealth a short time ago. Martin Lakos, a fairly surprising inflation result today. What did the market make of it?
Yeah, Tiki, good evening. It certainly was a surprise. That number came in at 0.6%. The best the market was looking for was 0.8%, with most economists fearing that it could in fact hit 1% for the quarter, and that would really have pushed out that annual inflation rate to 3.5% and almost ensuring an interest rate rise by the Reserve Bank. But it didn't come out that way. It does look like the strength of the Aussie dollar has helped out, with clothing and electrical goods prices easing, and the food basket probably not as high as had been anticipated. The market was really running on the back of expectations of higher rates, and we started easing back from reasonably positive news from overseas, particularly on the US earnings front. Aussie dollar was holding around 90 US cents until the CPI number came out, and then obviously with a bit of yield support coming off the market, that Aussie dollar fell back. So all in all, viewed probably as a pretty good number, in fact a very good number, and equities started to rally right through the afternoon on the back of that.
The Basel III regulations seem to have been watered down. What's that done to the local banking sector?
Look, it's very positive, obviously, for global banks generally. A number of the implementations, particularly the non-stable funding side, has been pushed out for implementation to 2018, so the banks have got plenty of time to get their balance sheets in order. But in particular for the Aussie banks, it's very, very good news. It's changed the ratio by which they've got to supply capital in the form of assets. Largely for Australian banks, that means the mortgages side as much as corporate bonds and government bonds. They've reduced the mortgage side from 100% to 65%, and they've also now allowing non-financial institutional bonds to be included in liquidity. So again, that's going to ease capital issues for Australian banks. It probably means they have some room to move on repricing of their mortgages. And if you've seen in the last 48 hours, the last 2 trading days, the bank sector has really performed very well on the back of that news.
Downer EDI has secured a $2 billion contract. How have investors reacted?
Yeah, look, very favourably. I mean, let's put this in perspective. The stock was $9 in January. It was about $7 in June when they came out with a negative guidance. So the market clearly hasn't been happy with how this stock's been performing. But today, the stock's up over 5% on the news of this contract with a joint venture with BHP and Mitsubishi for their Bowen Basin, basically a haulage and pre-stripping mining contract, including some machinery. So the market likes that, and the stock has bounced. To put in perspective, the stock was $3.30 at its worst and is now around that $4.50 level. And
what are the early signals now for the profit reporting season ahead?
Well, if anything's to go on the US reporting season, we're set for a reasonable season. I mean, clearly we've seen a couple of confessions come through in the form of QBE and IAG this week, and there's always a few negative surprises in this reporting season. We're still expecting somewhere in around about 27 to 30% earnings growth across the broad market, a very large proportion of that coming from the resources sector. But on the whole, it looks like it's going to be fairly solid from a lower base. And as I said before, some pretty good numbers, particularly out of US companies with global operations, are doing particularly well and have surprised the market on the upside. So we're looking forward to that. The bulk of the season really gets going in the first week of August.
All right, Martin Lakos, thank you very much for joining Late Line Business.
Thanks, Tiki.